Look, most investors out there think they've got a pretty solid handle on how oil, gold, and the US dollar all interact. You know the drill, right? You memorize those textbook rules or picked up those mental shortcuts from the financial news. The classic ones. A strong dollar is bad for gold. A weak dollar is good for oil. It's incredibly simple, and honestly, it's easy to remember. But what if I told you that this fundamental understanding is dangerously out of date? Seriously, in today's economy, these established correlations aren't just bending a little bit, they're literally breaking apart. There's a massive, unseen shift underway right now, totally rewiring the core relationships that have governed global markets for an entire generation. So welcome to this explainer. Today we're going to pull back the curtain on the hidden connections defining this new era so you can actually understand the mechanics driving the modern market. Let's get right into it.
I really want you to ask yourself honestly, are you trying to navigate this incredibly treacherous new financial world using a tattered, outdated map? Are you essentially driving your portfolio while staring squarely in the rearview mirror? Think about it. For decades, the whole financial world rested on this highly stable tripod made of oil, gold, and the dollar. Their predictable dance gave everyone a really comforting sense of order. I mean, if the dollar got stronger, you knew exactly what to watch for. If inflation popped up, you knew exactly where to hide. And let's be fair, those market laws helped generate trillions of dollars in wealth. But relying on those same assumptions today, it's literally like trying to drive a car by only staring behind you. It works totally fine, right up until you hit an unexpected turn. And relying on those outdated correlations today leaves investors incredibly vulnerable to shifts they just never saw coming.
So on one side, we've got the old textbooks. This was the era of predictable rules and nice, clean, simple correlations. But on the other side, we have today's reality. That stable bedrock of macroanalysis has suffered a massive structural break. We have officially entered a completely new regime. It's defined by an unprecedented mix of renewed geopolitical conflict, just staggering levels of government debt, and a global monetary system that is under incredible strain. The feedback loops between these assets, they've been entirely rewired. When you see a headline today about rising oil prices and reflexively assume it means just one thing, well, you're missing the mechanics underneath that have totally changed. Because until you understand this new wiring, you're basically investing blind, completely vulnerable to the shocks and volatility that are, frankly, becoming the new normal.
All right, Section 1, the traditional financial dance. Let's make sure we understand the classic correlations before we break them down.
To really grasp this profound shift, we have to start with the undisputed conductor of the global orchestra, the US dollar. Now, the dollar isn't just another currency ticking away on a screen. For the better part of a century, it's been the absolute backbone of global finance. It is the world's primary reserve currency, which simply means central banks everywhere, from Beijing to Berlin, hold vast amounts of it. And this dominance was powerfully cemented back in the 1970s with the petrodollar arrangement. That specific setup made the dollar the exclusive currency for pricing and trading the world's most vital commodity, crude oil. Basically, if you were an importing nation and you needed energy to run your country, you first needed dollars. This created a relentless, persistent global demand, establishing the greenback as the ultimate pricing anchor for nearly everything we consume.
And, the numbers really speak for themselves here. The US dollar makes up roughly 59% of all official foreign exchange reserves. On top of that, it sits on one side of a staggering 88% of all global currency trades. I mean, that isn't just dominance, it's a structural necessity for the whole global economy. Because of this massive scale, a strong dollar historically put a mechanical downward pressure on commodities, like oil and gold. Why is that? Well, it's pretty straightforward. When the dollar strengthens against other currencies, it takes fewer dollars to buy a barrel of oil. But think about a buyer in Europe or Japan paying in their local, now weaker currency. For them, the price just shot up. That usually cools their demand. And that right there is the mechanical reason a strong dollar traditionally squashed commodity prices.
Okay, next up is gold. If the dollar is the king of currencies, gold is definitely the king of monetary assets. It's got no CEO, no board of directors, and absolutely no government that can just decide to print more of it. For thousands of years, it's been the ultimate safe haven, the place investors instinctively run to during economic chaos or war. It's the classic hedge against inflation, but the smartest investors out there know a deeper secret. Actually, scratch that. It's not a secret, but it's a crucial mechanic. Gold's price is most tightly linked to real interest rates. That is, your interest rate minus inflation. When real rates are high, your cash sitting in the bank actually grows in purchasing power, so holding a shiny lump of metal that pays you zero interest becomes way less attractive. But when real rates are low or even negative, and your paper cash is literally melting away in value, that's when gold shines the brightest.
Finally, there's oil. Unlike gold, which is mostly a financial asset, oil is the literal, physical engine of the modern economy. It powers absolutely everything. And because of this, oil's price has traditionally acted as a pure barometer for global economic health. The old logic was incredibly straightforward.
When the global economy is humming along and factories are churning out goods, demand for energy naturally rises and oil prices go up. Makes sense, right? And when economies slow down or face a recession, demand slumps and oil prices typically fall. For the longest time, it was an incredibly reliable indicator of macroeconomic health. But, as we're about to see, this logic is now deeply, deeply flawed.
Which brings us to Section 2, the structural market breakdown. Let's look at why the old rules no longer apply. Okay, so we've established the classic dance, right? Well, that dance is officially over. It has been completely replaced by a chaotic brawl across global markets. And here is the geopolitical wrench in the gears. The defining feature of the energy market today is that oil is trading as a pure geopolitical risk asset. It is no longer just a simple commodity measuring supply and demand, it's practically a weapon. Oil prices are now reacting to the pure fear of future supply disruptions. We're seeing prices surge dramatically on news of escalating tensions in the Middle East or issues in critical shipping lanes, even when not a single barrel of actual supply is taken off the market. The market is pricing in anxiety, not reality. A simple diplomatic statement can now easily overpower weak economic data. So, that old model of looking at economic growth to forecast oil demand? Utterly broken.
Moving on to Section 3, the vicious feedback loop. Let's talk about the Fed's dilemma.
This new reality has created a massive headache for central banks. Walk through these falling dominoes with me for a second. Step 1, geopolitical tension flares up overseas. Step 2, that pure fear we just talked about causes oil prices to artificially spike. Step 3, because oil is an input in literally everything, that surge feeds directly into massive inflation fears. Step 4, the Federal Reserve, whose main job is to kill inflation, sees this and is forced to become aggressive. They hike interest rates and pledge to keep them higher for longer. And finally, Step 5, this hawkish stance causes money to flood into the U.S. to chase those higher yields. The result? A supercharged, incredibly strong U.S. dollar and spiking real interest rates. And as we learned earlier, high real yields are absolute poison for gold.
So the crucial takeaway here is captured perfectly in this quote. The very same geopolitical risk that should be bullish for gold is now the catalyst that undermines it. Just take a second to think about how crazy that is. The old rule was so simple. Crisis means buy gold. But today, because of that vicious feedback loop, a crisis spikes oil, which forces the Fed to hike rates, which ultimately hammers the price of gold. Gold is completely trapped in a vice created by oil and the Federal Reserve. If you blindly buy gold on geopolitical headlines today without watching real yields, you might end up experiencing the exact opposite results of what you intended. And the final piece of this puzzle is what we can call the dollar's paradox. For years, we've heard endless chatter about de-dollarization and how the US dollar's days are numbered, right? But then, why is the dollar suddenly rising alongside oil prices during a crisis? Well, in the old era, the US was a massive energy importer. Higher oil prices were a brutal drain on the US economy, which naturally weakened the dollar. But welcome to the new era. Thanks to the massive shale revolution, the US is now a major energy exporter. This changes absolutely everything. Today, high energy prices can actually improve the US terms of trade relative to big importers like Europe and Japan. This paradoxically supports the dollar during an oil shock, whipsawing gold's identity even further. It's a total game changer.
Now let's look at Section 4, the new investor playbook, how we go about adapting to geopolitical economics.
Since the era of predictable financial physics is completely toast, we need some new rules for survival to build a resilient portfolio. Number 1, you have to uncover the why. The era of if this, then that is over. You must ask why oil is up. Is it because of strong global growth, which is great for stocks? Or is it a drone strike which triggers that vicious Fed feedback loop we talked about? Number 2, obsess over real interest rates. This is gold's true north. Ignore the noise and the headlines. Watch what the bond market expects the Fed to do. Number 3, treat geopolitics as a core fundamental. Seriously, following naval movements in strategic choke points? That's no longer just for military analysts. It's a core competency for any serious investor now because it directly impacts energy and inflation. And number 4, rethink true global diversification. A simple 60-40 stock and bond split isn't going to save you when everything sells off at once. You have to deliberately diversify into assets outside the direct control of a single dominant power.
So here's the bottom line. We have officially left the old map behind. The simple, inverse relationships you learned in textbooks have been completely short-circuited. The dollar is a paradox, somehow benefiting from crises. Oil is now a measure of global fear, not just economic health. And gold? It's trapped in a massive identity crisis between its long-term appeal and those brutal short-term interest rates. To survive as an investor today, you simply must embrace this complexity. In this weird new era of geopolitical economics, where crises perversely strengthen the US currency, we have to ask, will this chaotic new wiring actually cement the dollar's power for another entire generation? That is the ultimate question defining the new macro map. Thanks for joining this explainer, and we'll see you next time.